Is there initiation fee? There's, asset management fees or stuff
Yeah,
like
let's
that.
talk
What
about the
type?
process and let's talk about the fees. So first of all, we only get paid, and that's the tax attorney, and that's my company, Capital Gains Tax Solutions, as the trustee and the financial advisor, if the deal closes and if they use the deferred sales trust. But we will do the education, we'll do all the preparation, and we will work with trusted advisors and educate really everybody. And if they decide not to do it or it doesn't work out, no problem. We're not owed anything. So that's the first thing. Second, yeah, you just set up a one-on-one call with us, and we have a deferred sales trust calculator. You can go to our website at capitalgainstaxsolutions.com, and you can answer 12 questions, and that's going to give a side-by-side comparison of pay the capital gains tax or use the deferred sales trust, and that's going to establish what's the liability. Is it worth it? And just give you some rough numbers. For every 100,000 of liability, we need about $500,000 or so of proceeds. So if your deal is smaller than that, we say just pay the tax. Or if your liability is smaller than that, just pay the tax. Also, the ratios have to make sense. If you're selling a $10 million deal and you only have $300,000 in tax, just pay the tax. It's too small. But if you're selling a $10 million deal and you have a $4 million tax bill, okay, that's substantial, right? That's 40%. So the ratios have to make sense. But essentially, we get on, we find out your goals, we find out what you're trying to do, what you're trying to solve, and then we say, okay, here are the benefits. By the way, one of the major benefits too for your ultra high net worth individuals who are listening to this podcast, and that means anyone above 11 million single or 22 million married, is what's called the estate tax challenge, okay?
Hmm.
So in a 1031, you can defer the capital gains tax and you can get the stepped up basis when you pass, and your kids can. But it has nothing to do with the estate tax. It's a whole separate tax, which is 40% of whatever's left inside the taxable estate above and beyond the exemptions. So for example, let's imagine someone's worth $52 million and all 52 million is in the estate. Right now, if they're married, 22 million is exempt, but that 30 million that's remaining is going to be hit with a 40% estate tax unless and if the funds are moved outside the taxable estate.
Mhm.
Now, the intent is to get it outside the taxable estate. The problem is it takes a long time, and or gifting, you run out of time to do it. Meaning you can give small amounts into what's called FLPs, but eventually you either run out of time or you run out of exemption to get it all out. Whereas in the deferred sales trust solves that in one single transaction. Let's imagine you had a $30 million portfolio you were selling. We can move it all outside the taxable estate, defer all the capital gains tax, which would mean we save your heirs or the estate 40%, that 12 million. So nothing else we know of does that
Mhm.
in that efficient of a way and one single transaction. So, but back to what we're talking about here. We're going through the process. So we gather all those facts. We gather all those facts and say, here's the tool. How do you want to use it? And that's really our goal. Our goal is just to educate, and we're just the guide. And honestly, I'm just kind of like the nurse, Dwaine. I just take the pulse. I'm not the expert. I'm not the CPA or tax attorney. I take the pulse and I say, hey, you might need capital gains tax surgery here. But before you do, you want to bring in your brain surgeons. Who are those? Those are the trusted advisors you worked with for years, your CPAs, your tax attorneys, and have them talk to the brain surgeon over here, who's the deferred sales trust brain surgeon, and make sure you get the blessing before moving forward, okay? And if and when you do, great. We'll move forward, we'll close, and a lot of those advisors then join us after they see the value we're bringing to them and their clients. And that's it. We close at escrow. It's kind of like forming an LLC. It's some extra paperwork. We're forming a trust. The trust has a new EIN. As far as the investor, they just get a 1099 based upon the income they're receiving. They're going to pay ordinary income tax on that.
Mhm.
And then the trust, my role as a trustee is to file a tax return on behalf of the trust to make sure we're reporting that all accurately as well. Now, in regards to the fees, how much does all this cost? Remember in the beginning, I mentioned about 1.5 points. That's the ongoing recurring fee, generally speaking, based upon how and where the funds are invested. There's a one-time upfront cost, which if you for the tax attorney, it's 1.5% on the first million, and then 1.25 on anything above that. So let's just say it was a $3 million deal. The first
Mhm.
million would be 1.5%. The remaining 2 million would be 1.25. Now that includes legal and the tax structure, but also includes audit defense for the life of the trust, which is key here. There's other structures out there that may or may not offer audit defense, that may or may not offer have the track record of the IRS closes, And so you got to be really careful with what happens if somebody audits this. And we're going to protect you. The tax attorneys are going to protect you on that. And they're also going to defend that at no additional charge. So that's the tax attorney fee. The trustee fee is about 50 basis points. So that happens at close of escrow. And then it happens once a year thereafter, as long as it's with a financial advisor. Now, if you go to a real estate deal, outside deal, then that's going to double to about 100 basis points. Although the financial advisor is no longer managing the funds that went out. So generally speaking, our notes earn 8, but after fees of either paying the financial advisor and the trustee, it's going to net about 6.5. Now, the bigger picture is at the end of 10 years, the goal and the obligation that we're trying to shoot for is that 8% net of all fees to the client, okay, to the note holder. And so, although the cash flow is about 6.5% along the way, and but at the end of that 10, we want to try to hit that 8. Okay, you can renew it at 10 years and renew, pass it on to your kids. So, and essentially, you can let this keep going for as long as the laws allow.
You have just listened to another information-packed episode of Capital Gains Tax Solutions with Brett Swarts. We hope you enjoyed today's show and found it helpful. Visit capitalgainstaxsolutions.com to access the show notes and to access more resources. Don't forget to leave a review and join us again next time.